Good day, students. In this video, I'm looking at the low interest loan fringe benefit. We're just going through the theory. There'll be another video working through some examples. So this is a relatively straightforward fringe benefits. You have a situation where there's a loan between the employer and the employee, and the interest that's being charged on that loan is either very low or there's no interest at all. We would then benchmark that actual interest against the SARS official rate. The SARS official rate is calculated by taking the repo rate plus 1%. The repo rate is the rate that's published by the South African Reserve Bank. It's the interbank lending rate. So be careful of what the question is giving you. If you've been given the repo rate, you need to add 1% to get to the SARS official rate. If you've been given the SARS official rate, there's no further adjustments to that. You would then compare that to the actual interest being charged on the loan and multiply by the capital outstanding and work out your fringe benefit. It's important when you're working with interest to always use the number of days instead of the number of months for your apportionments. So make sure in the question you work out the number of days that the capital is outstanding for, divided by 365, and that's what you use to apportion the interest. Do not confuse this fringe benefit with the fringe benefit that's in respect of subsidies in respect of loans. So that is a different fringe benefit where the employer is getting involved, but the actual loan is between an employee and a third party. And the employer then volunteers to either pay some of the interest or some of the capital repayments for the employee. And this fringe benefit, the loan is directly between the employer and the employee. I've included a link in the slides to where SARS publishes their official rate, so you can refer to that as well. It does change as and when the repo rate changes. But please be aware that some of the questions will give you a fictional SARS official rate. Just work with what is given to you in the question. Some of the exclusions from this fringe benefit, so these are instances where it is a fringe benefit, but there's zero attached to it because it's been specifically excluded in terms of the 7th schedule. If it's a casual short-term loan of 3,000 rands or less, so that means it's a loan that's repayable in 3 to 6 months, and the value of the loan does not exceed 3,000 rands, then we do not work out a fringe benefit on that amount. If it's in respect of a study loan, so that means the employee has requested a loan from an employer and is being provided at low or no interest, but the purpose of the loan is to fund the employee's studies, then there's no fringe benefits there. The last one has a couple of criteria attached to it, but the essence of it is it's to basically encourage employees to obtain loans for residential housing, residential properties. So you have a loan that does not exceed 450,000 given to an employee by the employer, and the value of the property that they want to buy is 450,000 rands or less, provided that the employee's remuneration proxy is 250,000 rands or less. That loan, even if it is at low or no interest, will not trigger a fringe benefit. The value of the fringe benefits is you would take the difference between your SARS official rate and the actual interest percentage that's been charged, multiply by the capital that's outstanding, multiply by the number of days divided by 365. And that's what you would include into gross income in terms of special inclusion, paragraph I. You also get a deemed low interest loan, where it's actually arising from circumstances where you have an employee living in a house owned by the employer and they are leasing that house from the employer, but there's a condition in the agreement that says the employee is entitled to or has the option to acquire the house at a certain fixed price in future. So they've got that option to buy the house from the employer. Then the third criteria is that the rent that the employee is paying is based on a percentage of that price that they've agreed to in the future. If all of those criteria are met, then the employee will be in a situation where there's a fringe benefit arising. It's a deemed low interest loan, and you'd have to work that out. Just take a note that the option to acquire the house at a future price can be given to the employee, to their spouse, or to their minor child. The fringe benefit would still apply and it would be included in the employee's gross income. The value of the fringe benefits in that case would then be, you would look at the SARS official interest rate minus the percentage that is being paid for as the rent, multiply that by the agreed purchase price, multiply by the number of days divided by 365. So this formula works if you've been given a percentage for the rent. Sometimes the rent will be given to you in rands, then you have to use the alternative formula where you start with the agreed purchase price, multiply by the SARS official rate, and apportion that for the number of days that the lease has been in existence for, and then you would minus the rent expense in rands. Okay, that's the end of the video for low interest loans.